Hello, everyone. Many thanks for joining this panel session. We'll start off with quick introductions and then move on to the actual panel discussion. I'm Anish, Shah, Research Director here at Chartis, leading the research in the areas around core risk management, credit lifecycle management, and the RegTech sort of markets. I'm honored to be moderating the discussion with our esteemed panelists, and I'll allow each of them to do their own introductions. Our first panelist is David Whitehouse, who joins us today from Sumitomo Mitsui Trust Bank. David, over to you.
Thank you very much, Anish, and hello to everyone. My name is David Whitehouse. I head up the Corporate Risk Management Department at Sumitomo Mitsui Trust Bank.
Our second panelist is Tony Fenianos, who joins us from the Afghanistan International Bank. Over to you, Tony.
Hi, Anish. Thank you so much. I've been managing credit and risk activities in different banking organizations since 2006, mainly in emerging economies, Lebanon, Syria, then Lebanon, and now in Afghanistan. Thank you so much for having me.
Thank you, Tony. And our final panelist is David Hernandez, who joins us from the Bradesco Bank. Over to you, David.
Thank you so much, Anish. Good day to all. David Hernandez. I'm the Chief Risk Officer for Bradesco Bank. We're the U.S. subsidiary of Banco Bradesco in Brazil. Here, manage all risk for the organization in North America, being regulatory, financial risk, and operational risk.
Perfect. Thank you so much, David. So the topic for today's discussion is heavily focused on the Chief Risk Officers and the Chief Compliance Officers, addressing the key question on how the shifting macroeconomic environment is going to impact their risk strategies, especially from a credit risk perspective. We'll talk about the key issues and challenges, the structural shifts, the impact of the rising interest rate, and the corresponding impact on the consumer behaviors. We'll also discuss about the role of data and technology in the credit risk frameworks and its convergence throughout the credit life cycle. Finally, we'll touch base upon the topic around the issues and challenges around the liquidity risk management and the corresponding risk strategies. So coming back to the actual panel discussion, my first question is for you, David Whitehouse. How is the shifting macroeconomic dynamics is impacting the offices of the CROs and the CCOs, especially from a credit risk perspective?
Thank you, Anish. Yeah, this has been an interesting year or so in terms of the macroeconomic environment. I'll just maybe cover a couple of topics that I've definitely been observing here at SMTB. I mean, for one, interest rates, as you mentioned in your introduction, there's been a change in a number of bank interest rates across the world, and that's really increasing the borrowing costs of whether that be a company or a consumer. We've also seen inflation rise quite significantly, and in some countries we've seen that to be double-digit growth there. So the purchasing power of an individual has been quite a challenge over the past year or for even longer. Thinking about exchange rates and currency fluctuations, it's really impacting the revenues of some companies, and particularly the hedging strategies have been really prominent and important for companies to succeed. A key driver of that is supply chain disruptions. Now that can be for a number of examples, whether that be for natural disasters or geopolitical tensions. Again, that's causing a lot of volatility in kind of raw materials and commodity prices, and it makes it really challenging for businesses to kind of forecast their kind of purchasing power going forwards. Technology and innovation as well has been a key driver. I think we're in a world or a situation where people want things now, if not sooner. And I think you have to be the first to be able to deliver a product to be able to win at this. If you're not able to deliver at a fast pace, you're falling behind. I've mentioned environmental factors in terms of kind of how that can affect kind of supply chain disruption as well, but also that may come as a premium for some products or some businesses who are wanting to look at a more sustainable approach. But as the kind of innovation of kind of certain sustainable strategies is coming through, that is coming at a premium, and there is obviously a cost towards that. I think all of that really impacts not just businesses, but also the consumer as well. And they've almost got a perfect storm of increased costs wherever they look, whether that be for maybe mortgages and the rising interest around that, kind of delaying decisions in terms of making the next move or even getting on the property ladder. But that's also impacting some of the day-to-day stuff as well. If we think about inflation, the purchasing power has come down quite a lot as well. In terms of businesses, they're really having to adapt their kind of strategies and ways of going forward in terms of building that revenue, but also keeping costs down as well. For example, commercial real estate, we're starting to see valuations drop, and in some cases up unto 20%. And again, that's just kind of the change in nature of how people are working today and the requirement for commercial real estate. That then impacts maybe retail and hospitality in those areas where if there's not enough footfall coming in, the revenue has got to be driven by increased prices just to kind of match the same demand as there were maybe 2 or 3 years ago. So it's a never-changing world, and I think that is a real challenge for kind of chief risk officers, chief credit officers around the credit risk strategy. Definitely understanding that they are in a higher risk environment at the moment and having to change the strategies to be able to compete with that. I think it's really important now to look at kind of the collateral management, because there's the probability of things could go wrong. How are you going to be able to recover that debt? I think that's a really key area as well as early warning indicators, and trying to be as ahead of the situation or gain enough insight to kind of prevent things from happening before they actually come to fruition. So yeah, I think there's definitely a big focus there for the CRO and CCO.
Correct. I think I kind of agree on all the points, especially the point you made around hedging, and irrespective of the segment, whether it be retail or wholesale, I think each segment, they have their own sort of challenges and the right sort of risk strategies to address. Yeah. The second question then comes to you, Tony. What keeps the CROs and the chief credit officers awake at night? What are their key issues and challenges?
Yeah. Yes. Actually, I think today we have a mix of risks, actual risks, and we have a lot of uncertainties. It's not only actual risks. As David mentioned, credit risk is a major concern today. I would add that because of the pandemic, the structural change that the pandemic brought, the technological advances, the changes in the preferences and the spending behaviors of consumers, these factors actually made a lot of businesses shut down their operations. Of course, comers, we have newcomers in the market, but many conventional businesses had to shut down or are at the verge of shutting down. This also played a big role in the structure of markets for credit risk. The second risk, which is also imminent nowadays, is cyber risk. And this is precisely because of what happened during the COVID-19 pandemic. We have a new digital market platforms. As I mentioned, we have new habits for consuming, and we have a new normal in doing and managing businesses. And all this is centered around new technologies. Banks today, not only banks, also their clients, they are all subject to the cyber risk and the risk of information protection. What's making things more difficult is that these changes are not stopping. they are continuous, they are rapid, and they are complex. I mean, every once in a while you have a new complex development, and this puts in question, the resources that we have in risk management and the data that we deal with. The risk managers originally, they are not IT experts. Risk officers are not IT experts, and it's very difficult to understand and capture the full array of these new risks. The models and the systems also that we were using in the past are becoming more and more obsolete nowadays. Our systems are based on statistical models. Now you have all this data, you have all these developments, which is making our systems obsolete. For risk data also, now the recent developments allowed banks to access more data in huge volume. But this also is creating more challenges for us. The aggregation of risk data is becoming more challenging. How to choose, what to choose, the most accurate data and the most reflective data is becoming more and more difficult because of the availability of large amount of data. And most importantly, how to use this new data in our models, in our statistical models. This is very challenging. Besides credit risk and cyber risk, I would say that the third important risk is operational risk, because of the external events, the increased external events that we have been seeing in the past month and the past years, such as extreme weather conditions and natural disasters. The frequency and extent of these events definitely require the review and upgrade of all BCPs. And maybe we need probably a new approach for BCP management. Finally, interest rate risk, as already highlighted by David. Well, it can be deteriorating, and we saw that. It was a fact. We saw big banks, well, not small banks, definitely, falling down because of interest rate risk. Now, besides all these actual risks, we have uncertainties, and personally, I'm more bothered by uncertainties than actual risk, because we don't know what's going to happen. The first big uncertainty is related to the US economy. So there are concerns that we could have a potential recession in the economy. There are concerns that more banks could collapse in the future. For the first time probably first time ever, we have some kind of uncertainties around the US bonds. With the size of the public debt of the United States reaching new records high. We had in the past this issue on the statutory limit of debt. Most recently, a few days ago, we had this concern over the government shutdown. We had in the past few months the downgrading by Fitch. So there are concerns over there, right? And we all know the size of damage that could be caused by any of these concerns if it comes to life, to the global economy. Another uncertainty is related also again to interest rates, because we don't know if the increases in interest rate are going to continue or not. Probably they are going to continue for the short term, but we don't know what's going to happen in 2024. Third uncertainty is about financial markets and the performance in the financial markets. Last year was a disaster for financial markets. Prices went down for both equity and bonds, and this year I think volatility is still there. We need to understand how these markets are going to operate in the future. We have geopolitical tensions, and we have an increasing focus and interest on a alternative international currency. This is big, and this is big. Maybe it will take time to to start panicking us. But I think it's already, it's starting. Other uncertainty is related also to crypto assets. We know very well what happened. Crypto assets are not doing well. Also, many banks and institutions are involved in crypto assets, and any damage in that area would cause problems to conventional institutions. And finally, the digital transformation and the technological advancements. It's all not stopping, and all these represent real big uncertainties for risk managers around the world. I would end by saying that things are happening quickly. The issue of banks in the United States happened quickly. The crypto asset issue also quickly. The European bank case also happened quickly. I will also say that the non-financial factors playing a big role in damages today, like fraud and lack of transparency, represent also major concerns. Thank you.
Perfect. Tony, I think that was super helpful. I think a couple of points around risk data aggregation. I think you brought up cyber risk. I think that was the next one. Liquidity, I think we have discussed. But then the US kind of challenges and the story. I think what you mentioned was really interesting, and that takes me to my next question to David Hernandez now. From a US perspective, if you could highlight the key issues and challenges you see in the North American market, especially in the US, I think that would be super kind of useful for our audience.
Sure, I'm sure be happy to. And first, definitely most of the issues that we're concerned here in North America and US and so on, mirror that David and Tony has mentioned. But obviously, I think we start from the top level. Us risk managers, we like stability, and we have anything but stability right now. And I think to Tony's point, this uncertainty, as someone put it the other day, we're not at a new normal. There is no normal, right? And we don't know where that's going to land. Yeah. So us risk managers, we have to really manage the risk to that unknown where it's going to go, that normal. Are we finally going to be able to level off and have some sense of normalcy and consistency? And I think that uncertainty is the biggest threat today. But those threats and uncertainty are very, very deep issues. And Tony and David has outlined a lot of them. First of all, on the credit side, let's face it, credit fuels economies, right? Lending fuels economies. We've had well over, before the pandemic, almost 10 years of certainty, of stability, low interest rates. We knew where the threats were coming from. We could manage them. Today, that's gone. So the first thing we have is not only a state of higher interest rates, but the speed of those higher interest rates. That's what really, I think, shocked most of us, is how fast central banks raise interest rates, particularly the Fed, to combat the inflation. And this is not a normal inflation scenario. This is, I think Tony used the word structural, right? So this is post-pandemic, as a result of the pandemic, a lot of structural changes. They're still beginning to finalize and normalize, and probably have not even hit their uncertainty peaks. And we're trying to manage that speed. A lot of banks have lost revenue. There's new hedging concepts and principles to try to hedge some of those risks, but it's very difficult when you have that speed and that uncertainty of speed. Their funding costs have gone up, where their asset side is still in a cycle of increasing those interest rates. So they haven't fully caught up, and I don't think they're really fully catch up until probably mid to end of next year, when you'll see some of the spreads, the NIMs kind of begin to stabilize. So for the banks itself, that's a leading problem, to manage that balance sheet and manage that profitability and so on, and hedge for the unknown, right? Commercial real estate is definitely a concern. I'm sure everyone has heard, that a lot of negative news, a lot of concerns. All the financial analysts were worried about office. Office ties into the structural issues, a change in behavior, right, of the consumer, even if the consumer is business, right? We don't know where office is going to go. So we see less lending in office, more conservative lending, and so on. We're worried about the increased interest rates as a result of for commercial real estate. But one thing that both Tony and David touched on, which I think is a really difficult part to manage, is the environmental changes, right? The environmental changes are beginning to really impact real estate in general. And obviously the first one, the more susceptible, would be commercial real estate, right? Particularly in areas here in the States, Florida, California, where you're sort of expecting this, but we're also seeing this in the middle of America, where there's been record number of tornadoes and events that have, it's destroyed towns, literally. And this was really totally unexpected. So how does that impact commercial real estate? Well, the insurance industry has been really hit. In some cases, for example, in Florida, insurance rates have gone up 400%. So you match that with increasing interest rates, and it's a perfect scenario where the borrowers begin to fail on their payments, right? To lag behind. And I think we're just beginning to see this as, fatigue hasn't hit in yet. I'm more concerned next year how these interest rate issues and insurance issues and environmental issues may impact. If there's an office building, for example, anywhere near the water, it's really difficult to manage these days, and even almost sometimes impossible to get insurance coverage. And that's a covenant for a loan and so on. So, it impacts on many different levels. We mix that. Tony brought up the cybersecurity, in the US, we're very concerned about this. This is something first, Tony was right on, us risk guys, we're not IT guys. So we're trying to mitigate that risk in an area that we really don't have a lot of expertise. Even the experts don't have the expertise, right? Even those guys who can talk the talk in the IT world are having a hard time keeping up with the bad guys. And imagine us trying to develop strategies and to plan for resources and to plan for vendors that can help and so on. It really is an unknown, and I think it's going to be an unknown for a very long time. And you put that on top of the uncertainty of interest rates, speed of interest rates, insurance issues, the change in behavior. It just clouds the issue quite a bit. Political risk, I think Tony talked about the issues in the US, and that instability doesn't help anything. Right, it's just a huge weight on the global economy and uncertainty, and again, new normals. Yeah, it's not normal, right? It's never happened before. So we're trying to manage all these, and I don't know about my partners here. I know for me, a lot of my day has shifted from data analytics to live risk management.
Right.
All right. Putting out the fires. So, pre-pandemic, my world was very much as let's look at data and predict. Yeah. Today, there's no time to predict, it's happening. Right. So when someone said there's going to be a Category 5 hurricane hitting, north of Florida, Category 5 happened once every 100 years. And now it's happening, every couple of years. To have the floods and the fires that we had in California, even Hawaii, right? Yeah, it's unheard of. So now we're literally putting out fires. For us, it's financial fires, and it's we don't have that time to be predictable because we don't have 6 months, and we don't have a year to look. We have today and tomorrow and this month and so on.
Yeah, perfect. I think that was super, helpful again, David.
Thank you.
So I think that brings me back to my sort of, concluding question. It's open for you all three. You could pitch in based on your experiences or based on what you see in the real life kind of story and challenges. So how do we see the risk strategies being adapted in the credit life cycle management, right? I think some of the key perspectives at Chartis, what we've been observing, the strategies being rolled out by the CROs or the risk officers, offices are around product designing, around hedging, around credit portfolio management and monitoring. What else do you see, from a credit life cycle perspective?
Well,
Maybe
I feel like
we start with David Hernandez and then we go to other panelists here.
all right. Definitely our strategies are changing throughout these changes in our environment, right? So these are all environmental changes when we think about it, right? So for us, the first inclination is to pull back on high risk activities. So you look at your policy, you look at some of the limits. A portion of our policy is maybe segmented out to more speculative type lending, more high risk lending. That's the first area that we begin to pull back on. Secondly is let's look at our current portfolio and let's look at the covenants, particularly commercial real estate and things like that. And how do we intensify our monitoring? How do we make sure that instead of once a year, we're at least doing some sort of high level review of our portfolio on an ongoing basis? And then lastly, there's a lot for us, we're big real estate lenders. So LTVs are a big deal. So, those LTVs for us have dropped in order to anticipate, some negative, movements in the market. One of the things we learned here from the big credit crisis and real estate crisis we had 2008, 2010 was that LTVs was the key thing. If you had a 90% LTV, it was certain to fail. If you had a 50% LTV, it was certain to pay. So we're working within those ranges to see how we can manage and pull back where we feel a little bit more comfortable and still continuing our lending.
Perfect. Thank you, David. Maybe to Tony now. I think very quickly, in the interest of the time, I think if you could highlight maybe 2 or 3 sort of key strategies, what you feel are relevant from a credit life cycle perspective. I think that would be super helpful.
Yeah, I totally agree with David. Mainly first thing we. Unfortunately, in the countries where I've been working, this kind of risk management has always been the normal. Lebanon, Syria, and now Afghanistan. So it's usually industry. We need to review the industries where we have appetite to lend, and secondly, the collaterals, because the traditional classic collaterals are not as solid as you think, as one might think. And 3, I think, disregarding the increase in interest rates, loans are going to be expensive. Loans are going to be expensive. So, and of course, we have all these requirements, international requirements and standard, mainly Basel, putting more pressure on credit risk. So industry, second, different collaterals, different approach for collaterals, and 3, I think prices of loans will increase even if interest rate stabilizes in the near future.
Yeah, thank you, Tony. Finally, to you, David Whitehouse, maybe your final thoughts.
Thank you, Anish. David and Tony have raised some really important points there around the strategies. I think the piece that I would like to add is just how you can be dynamic in those strategies and how you can adapt in those situations. David made a really important point of the risk management department has tried to be as proactive as they can be, but to Tony's point, in a time of uncertainty, it's really important to ensure that you're able to react as quick as possible and ensuring that your systems are able to do that.
Perfect. Thank you again to all our panelists for providing valuable insights. It was super helpful. I'm sure our audience would have enjoyed this session and have got some good takeaways from the discussion. Thank you again very much. Thanks.
Thank you.
Thank you.
Thanks.